Okay, this is just going to be a brief walkthrough of some of the exercises that deal with a change in our accounting principle, a change in our estimate, and error corrections. So this first one, we have a change in our inventory cost method. So we are going from average inventory costing method to FIFO, both of which are generally accepted accounting principles, but they do result in a different cost of goods sold and ending inventory. And then we have a tax rate of 25%. So they give us a table. So again, we're making this change at the start of 2024. So then we'd have 2023 and before 2023 that we would need to do adjusting entries for. So as we look at those 2 years, we've got a $17 million difference. So then that would, what on January 1st of 2024, we would want to do a journal entry to adjust our inventory balance by that 17 million. And then if you take the 17 million times the 25%, that is the 4.25 million that we would have a deferred tax liability for, because again, we're changing our methods both for financial statement purposes and for tax purposes. And then our retained earnings is going to be the difference. Well, I guess we don't know if it's for tax purposes as well, but it creates that tax difference. So that is what that deferred tax liability indicates, is it's creating that tax difference. Okay, then the second thing says determine the net income to be reported. So again, we're going from average inventory to FIFO. So for 2023 and 2024, we're going to go with that 22 million and that 17 million, but then we're going to take those net of tax. So for 2024, the 17 million minus 25% gives us that 1275. The for 2023, the 22 million minus the 25% gives us the 16.5. So always take it net of tax when we're calculating out that net income or that change. And then requirement number 4 says indicate the effect of the change on the 2024 and 2023 comparative statements, assuming cash dividends of 5.5 million each year, and there was no dividends paid prior to 2023. So then our retained earnings balance let's see, do we have it starting? Okay, so is that 1650 is the balance coming in at January 1st of 2023, and then we're going to add to it, what does it say though? 2023, no dividends are paid prior to 2023, but then 5.5 million. So 16.5, then we pay out 5.5, and then we add our net income that we had recorded in 2023, which is 16.5. So then that gives us that 27.5. Then 27.5, we subtract out the 5.5 in dividends that we're paying every year. That leaves 22. And then we look at what's our net income for 2024. That might even be on our first requirement here. No, okay, sorry. So then the 17 million less the 25% gives us 1275. And then we add that to that 22 million. And then that's where the 3475 comes in. So we're basically just, you gotta know what goes into retained earnings. So what did it start at? Then subtract out our dividends, add our adjusted net income, and again, adjusted to subtract out the tax expense, and then do that for each of the years. Then we change our depreciation methods. So our depreciation, we're going from, they're using the declining balance method of depreciation that was acquired at the beginning of 2021 for $2,768,000. has a useful life of 6 years and a $212,000 residual value. At the beginning of 2024, they decided to change to straight line method. So then we have the double declining balance, the 1,947,000 would be our balance. No, that's our depreciation that we've taken. So that would be our accumulated depreciation. So let's go down here. Yeah. So we've got our assets cost of 2,768,000 less our accumulated depreciation, again, which that's what's given to us up in this table. That tells us how much depreciation expense they've taken. So their undepreciated cost at January 1st of 2024, when they make that change, is $821,000. They estimate a $212,000 salvage value, so we subtract that out. And then now we're going to go to straight line. So we're going to say there's 3 years left. Again, go back up here. It told us that its useful life was estimated to be 6 years. We've already depreciated it for 3. So that means that's how many years is left is 3. Sorry about that. So then that is 203,000. So that will be the amount that we will record as depreciation expense in 2024 when we switch over to straight line. So again, when we're making a change in our estimate, we just adjust the current year and then the go forward years. So we got to figure out what its net book value is at the time of the change and then apply the straight line method. Okay, then we have warranty expense that is we're gonna change our estimates. So they sell commercial sprinklers, they carry a 1-year warranty. And because this is the first product that they'd offer the warranty, they really didn't have great experience. So they estimated 2% of sales. So the sales of the sprinklers in 2023 were 2,800,000. And then they recorded the following entries based on the 2% estimate. So they charged warranty expense and they credited the warranty liability at 2% of the sales. Then their actual expenses that came in were 25,760. And then they credited out, either the wages or the parts or whatever they needed. Then at the end of the year, they determined that, hey, these are more than we expected. We think it should be 3% of sales. So then assuming that in that year, in 2024, $3,900,000 is their sales and their warranty expenditures were $97,000. So if we come over here, we're going to take our $3,900,000 in sales, multiply that by 3%, and that gives us the $117,000. So we're going to charge that off to warranty expense and credit our warranty liability. And then as the products actually come in for warranty, we always take it out of the warranty liability and then credit the cash or the parts or whatever it is. Now then requirement number 2 says, assuming the sales of the sprinklers were discontinued after 2023, then prepare the journal entries related to the warranty. So then in that case, if we go back there, if we go back to the scenario, I guess I can stay in there. We only have $56,000 that we initially set up into that warranty liability. In 2023, we used $25,760. So then that leaves $30,240 in that liability. So then we're gonna debit that out, use up all that we can. Then what is remaining is going to be charged to a loss on that product liability. Because again, we don't have anything set up. We estimated it not great in the first place, and now the products are coming back. So it's going to be a loss on that product liability. And then we have an inventory error correction. So we realized that when we counted our ending inventories, we had some misstatements. So in 2022, it was understated by 142,000. And then in 2023, it was overstated by 194,000. So the first thing says determine the effect of the errors on the retained earnings on 2023. So if our ending inventory is understated, our cost of goods sold would be overstated. So then our net income would be understated. So our beginning inventory had no effect, it wasn't changed. So our ending inventory is understated, which makes our cost of goods sold overstated. Then when we're plugging that into our income statement, if the cost of goods sold is overstated, our net income is understated, and our retained earnings are understated. Then that mistake's going to carry over into the beginning inventory, so it's going to be understated. And then our cost of goods sold is going to be understated. And then our net income would be overstated. Now then our retained earnings will have corrected itself between those 2 years. So that always happens. Then in 2023, if our ending inventory is overstated, our cost of goods sold is understated, which makes our net income overstated, and then our retained earnings overstated. So there's always a reverse thing between ending inventory and cost of goods sold. If ending inventory is overstated, cost of goods sold is understated. If ending inventory is understated, cost of goods sold is overstated. Okay, then requirement 2 says now prepare the journal entry to correct the error in 2024. So it's the 2023 error, I guess, that we're correcting. So then if our inventory is overstated by 194,000, we need to reduce it. So we're going to credit our inventory 194,000, and then it's a prior period adjustment. So we're going to debit that retained earnings. It goes back to adjust last year's income. So we always debit retained earnings if that's the case. And then they would account for it retrospectively. So errors are always accounted for retrospectively.